When you deposit a paycheck or drop cash into a savings account, it's natural to picture that money sitting in a reinforced steel vault. You expect the bank to act as a passive storage facility, holding on to your exact bills until you come back to withdraw them. In exchange for letting them hold those funds, a traditional bank offers you a tiny reward, a massive spread between what a bank pays you and what it charges everyone else. The bank takes your cheap deposit and immediately rents it out, charging homebuyers a 7% mortgage rate, or billing credit card holders a staggering 24%. The math gets even more aggressive from there. The bank isn't just lending your specific dollar out a single time. Through a legal mechanism known as the fractional reserve system, banks are allowed to multiply that initial deposit. Your everyday deposit doesn't sit idle in a safe. It acts as the raw fuel for a systemic, highly profitable money creation engine. This simple spread between borrowing cheap and lending expensive generates tens of billions of dollars in profit annually for megabanks. The biggest financial institutions in the U.S. consistently pull in a 10 to 15% return on equity purely off this spread, making them some of the most consistently profitable businesses on earth. So, how exactly can a bank lend out exponentially more money than it actually takes in from its depositors? This mathematical multiplication is a foundational engine for retail banking, a cycle that transforms an everyday checking account into a multi-billion-dollar lending pool. Here is an animated diagram showing how this chain reaction begins. We start with a brand new $10,000 cash deposit, represented by this solid block at Bank A. Under fractional reserve rules, the bank is only required to keep a fraction of that cash on hand. The $10,000 block physically splits, leaving a $1,000 reserve block at the bank and a much larger $9,000 available block. The bank immediately puts that larger chunk to work. The $9,000 block slides away to a borrower, who uses it to purchase a car from a dealership. At this precise moment, Bank A still tells you that your $10,000 deposit is safe in your account, yet it has simultaneously injected $9,000 in brand new purchasing power into the real economy. The seller of that car takes their new cash and drops it into a new column by depositing it into their own account at Bank B. Bank B applies the exact same math to this new deposit. The block splits again, keeping 10%, or $900, in reserve, and lending the remaining $8,100 to a second borrower. This iterative loop of depositing, splitting, and lending continues down the line across the entire financial system. The numbers rapidly cascade and branch out into a massive interconnected web of increasingly smaller loans. Through this money multiplier effect, your original $10,000 in base money has legally created up to $90,000 in brand new credit. That credit functions exactly like real money for everyone using it. Because banks rely on short-term deposits to fund long-term loans, they only ever hold a tiny fraction of the actual cash they owe people. This structure creates a persistent vulnerability known as liquidity risk. If too many depositors realize this mathematical reality and demand their cash back at the exact same time, the illusion breaks. The bank simply doesn't have the funds to pay everyone, rendering it instantly insolvent. In 2023, Silicon Valley Bank collapsed in a matter of days after a sudden, massive bank run drained its fraction of liquid reserves. A localized panic like that can easily trigger systemic contagion, freezing the broader economy. That is exactly what happened during the 2008 financial crisis, when major Wall Street institutions completely failed. The fractional reserve system is an incredibly efficient engine for economic growth, but it is inherently fragile, built entirely on the psychological trust of everyday depositors. To prevent systemic panic, the government provides a psychological safety net, guaranteeing individual deposits up to $250,000 through the FDIC. Viewing the bank as a business that rents out your capital for 24% interest makes the standard 0.01% savings rate look like a lopsided trade. When you account for $30 overdraft fees, you are effectively paying the bank to generate profit for them. You can immediately get a fairer deal by moving your daily savings into a high-yield savings account, or by switching to a member-owned credit union to capture a significantly higher return on your cash. Once you understand that your deposit is the necessary fuel running their billion-dollar engine, you can stop leaving money on the table and make the banking system work for you.